Hello, everyone. Welcome back to Reimagine 2021. I'm Roshan Mirajkar. I'll be your host for this event, and I'm very excited. This is our 11th event. We've been doing these free Reimagine virtual conferences for the past year now, and our goal is always to feature the latest innovators, latest leaders in the space, and of course, the companies that actually support communities. I'm very excited to feature a special panel here today from our supporters, OpenOcean. So with me here today, I have Cindy Wu, who's the co-founder of OpenOcean. I have Joe DeTommaso, who's the investment portfolio manager at CMS Holdings. And we have Vijay Chetty, who's the head of business development for dYdX. So we're going to cover a lot of interesting topics. We're going to talk about some new tools in the market. We're also going to talk about, what is the future of DeFi? What is really the future of trading? So, to kind of just kick things off, one of the questions I think everyone has been asking about DeFi is kind of, what are some of the main success metrics and what are some of the innovations you guys have seen in DeFi in the past 2 years?
Yeah, sure. Happy to kick things off. So I think for us, as a decentralized exchange at dYdX, we really look at metrics that map to centralized exchanges and probably how a lot of the leading centralized exchanges are thinking about their businesses. So at the highest level, that maps to volume, open interest in terms of positions taken on, and then also liquidity in the books. So can somebody come in and transact at significant size in these markets? And of course, you have leverage involved, so you want to make sure that there's sufficient depth, particularly in periods of high liquidations. So that kind of trinity of metrics is what we pay a lot of attention to. As we've seen our volumes rise, we've tended to focus a bit more on market share. So what percentage of the decentralized exchange market are we, as well as what percentage of the overall derivatives exchange market are we? So we're paying a bit more attention to those two now. And then, of course, given that we're a decentralized exchange, the decentralization of the protocol itself is key. So ensuring that there's a wide base of users engaging at a governance level is also another key metric.
Yeah, I know you guys recently did your airdrop, and you have a lot of motivated community members. In your view, what are some of the tools that dYdX is building just on the DeFi or trading side that you think just couldn't efficiently be built in the TradeFi world?
Yeah, so at the highest level, we're really seeking to build kind of the same type of functionality that you see on centralized exchanges, but in a DeFi first manner. So a lot of that maps to the feature set that you may expect to see on the latest and greatest centralized derivative exchanges. So using FTX as an example, it's sort of a lot of the same trading features that you'd expect in order to have a great experience. Eventually, we plan to have support for multiple forms of collateral, which is another key product feature to expand the user base and expand the functionality. And then, of course, continuing to ship different order types like iceberg orders, and especially on the front end, and really kind of educating users on how to take advantage of that functionality is also a key part of the picture. I'd say the one area that we tend to spend a lot of time on is how can we securely do this in a decentralized manner, since obviously the benefit of using a decentralized derivatives exchange like dYdX compared to centralized exchanges is really that you get the benefit of self-custody and the security and flexibility that comes with that. So we think a lot about how can we continue catering towards interoperability and to ensuring that we provide users with those benefits of security and then, of course, ease of use on top of all that, because a decentralized experience kind of introduces a bit more complexity to the user onboarding. But I think we're also quickly finding a lot of users getting comfortable with that. And so that's kind of opening up some interesting new spaces too.
Yeah, I think you're right. It's kind of a learning curve, obviously, and I think there's a gap too between how much capital the institutions have and how much knowledge some retailers have. And I guess a question for you, Joe, I think would be good to answer is kind of on the flip side of it. To what extent do you think, like, I feel like everything in DeFi, it's very collateral driven, right? We don't really have, uncollateralized loans. They haven't really hit the inflection point yet. So to what extent, when you're thinking about diversifying a portfolio, would you use some of the TradeFi tools, or would you use just all of the DeFi tools or pools?
Yeah, I mean, so for us, we kind of sit on both sides of the spectrum. So, I mean, we do play very much in more of the traditional sense on centralized exchanges, trading more traditional strategies, kind of focused around trading futures curve and things you might find back in TradFi. I think we kind of sit on DeFi a little heavier nowadays. So we run quite a bit of strategies, or automated strategies, I should say, across the derivatives protocols. So we're starting to get ramped up on dYdX. We've been active on things like perpetual protocol for a while. So, I mean, for us, like, we really try to, I guess, bridge the gap, for lack of a better term, between using both things. I mean, we don't really feel like you need to stick to one side or the other, whether it be DeFi applications or centralized platforms. But we think that there's kind of a space for both of those. So, I mean, when we think about portfolio allocation, we're kind of active on both sides of that regularly. So I don't think we take too much into account kind of one or the other, if that makes sense.
Yeah, definitely. Like, kind of playing on the strengths of each ecosystem. And I think there's a lot of, I guess there's a lot of different trading strategies and even like kind of like a risk parameter, right? With all these tools. Cindy, I think if you want to go and talk a little bit about what is, OpenOcean's DeFi trading strategy, like, are you guys kind of using all of the different markets like spot, futures, or do you guys only focus maybe on chain, like just on chain investment?
Yeah, and OpenOcean is we are acting as a full aggregator because we are a team from traditional finance and traditional financial exchanges and wealth management and private equity. So when we land into the DeFi space, we find like there are some kind of inefficiencies. For example, it's very difficult to trade across various networks and to do cross-chain, and even like within one network, it's very difficult for you if you want to swap a token pair. When it is not supported by the pools, you cannot swap against each other, and the price varies from various networks and various dexes. So what we are aiming to do is to provide, like, increase the trading efficiency of the users and to make most profit for them. That's why we came to the idea of bringing building a full aggregator. We aggregate the various dexes on various public networks to provide traders with one-stop entrance for DeFi tradings right now. So that's how we came to the idea of a DEX aggregator first, to build on various public networks. We are now on 10 public networks, including Ethereum, Solana, Polygon, Avalanche, Phantom, and Charm, etc., and Binance Smart Chain. And we find the best price for users on various networks. And the next stage we are going to do is to launch our cross-chain best price swap services. So basically, we are integrating the cross-chain bridges and the OpenOcean algorithm to find the best price for users to swap cross-chains. And also, like, this is the swap part we are building on, and also we are going to aggregate derivative products, because we think as a trader, there are lots of trading opportunities for you to trade on spot and derivatives altogether. For example, there are some spread opportunities for you to trade and do arbitrary tradings between spot and futures, and also you can run your CTA strategies, etc. So we are working along the way to aggregate derivatives besides swap. And on the swap side, we think for the users, because for the users, they start thinking about whether I need to trade on DeFi or CeFi. So we provide the price comparison for users on OpenOcean. You can check the price difference between the best price OpenOcean provided for you on across the most public networks. You can check the asset price there, and you can check the price difference between it and the and CeFi. So right now we aggregate Binance. So after you check the price difference, you make the comparisons, you can make the decision. You can make free choice for you whether to trade on DeFi or CeFi. So that's what we think. We are thinking for our traders and for the users' perspective, what they need when they are trading on DeFi and CeFi.
Yeah, that makes a lot of sense to me, because I think to some extent a lot of people use certain protocols just because you cannot you don't have all the data, you don't have the full picture about what are the different tools or even markets that are available on all these different chains. A kind of an open-ended question. So is the when we talk about capital efficiency and building more efficient futures markets or just markets in general, is that more of a development with technology, or is it, what really makes a trader a good trader? Is it just the efficiencies in the technology they're using, or what are some other metrics you guys think about when designing your trading products?
Yeah, I'll start with that. So we kind of think about capital efficiency at sort of two levels. So in terms of the product we're building, there is capital efficiency inside of the dYdX platform. And so a big step that we made with the launch of our latest perpetuals product was supporting the ability to cross margin across all the perpetual pairs that we support. So you can go long on the BTC perp and the ETH perp and then short another perp, for example. And that's all happening out of the same collateral pool. So that's a huge advantage for particularly a lot of the pro traders, market makers, the trading firms that tend to run strategies across a number of pairs. And we're also seeing growing usage of that cross-margining capability from the long tail of users on dYdX as well. So that's something that is encouraging to see from a capital efficiency perspective. And then obviously, as we continue taking steps in that direction to support additional forms of collateral, that just expands that pie a bit. And then the other level that we tend to think about it as well is in terms of kind of interlinks in the market, right? And I'm sure that Joe and Cindy are thinking a lot about this as well, since they really kind of play there. But effectively, aggregators are becoming more and more important at sort of an overall market level, I think, just given the explosion in the number of venues, the different layer ones and different forms of collateral supported. So having aggregators is a great way to kind of make that easier, particularly for the long tail of users. And then also market makers are huge in terms of pricing efficiency across venues. So we also seek to work with and partner with a lot of market makers and aggregators as well.
Yeah, it's it's kind of interesting. You have this world of DeFi. You also have a lot of CeFi products. Would you say that when we're talking about things like perpetual swaps or even futures products, like to what extent did retail users not have access to these things before? Is it a question of knowledge, or what is that really? What effect does this have on the market, I guess, for people that don't really understand the impact of all of the tools that you guys are building, right? Is it only for? I feel like there's like a misunderstanding. People think it's only for institutions, right? How would you guys explain it to these people for like? Even if they're not involved in these products, what impact does it have on the market? Like, is it all bad, just with leverage? Or I guess maybe let's talk about some ways it helps the market maybe mature or grow.
Yeah, definitely. I mean, I can hop in there. I mean, I think generally speaking, despite like more leverage being added to the ecosystem, we're always looking for just liquidity in general. And I think some of the venues that you find the most of that are derivatives platforms. So specifically, it's been a lot of futures contracts or perpetuals on Ethereum. And for us, I mean, we find that this just provides an overall benefit in the sense that there's more liquid markets, there's more trading action happening, you're getting a more accurate price across a longer time frame because of the liquidity that's available across the space. So I mean, for us, I think we only really see this stuff as a net benefit. I mean, I suppose you can get down a few winding roads on whether the leverage stacks up and becomes an issue down the line, and we should be worried about that. But I think generally speaking, these platforms are kind of bring more liquidity to the space, whether it be a trading venue or lending, borrowing. I think that's just a net positive across the board, really.
Yeah, and talking about liquidity, so it's also like one of our future plans to aggregate the decentralized derivatives that we can offer users free choices to choose the liquidity, because there are, you can see like the liquidity difference between various and derivative products. So that's one option we are working on, so to bring the convenience for users to use. And the other thing we are building on is like we are going to build a combined margin pool on OpenOcean to assist users to trade simultaneously on various derivative protocols across multiple networks. So this also increase the capital efficiency in derivative trading. For example, if you want to do long position on dYdX and you want to do short positions on perpetual, so on OpenOcean with one single combined margin pool, you can trade on various derivative exchanges on different positions, and your risk exposure can be offset with the long and short positions. That's something we are building on, and to facilitate users one-stop trading across various derivative exchanges. And we are trying to solve the liquidity issues with this kind of solutions.
So one thing I would add on this point is definitely like, I think the types of innovation that we're seeing in the market and the example that Cindy just alluded to and sort of everything that's happening on that front, I think are things that were largely kind of inconceivable in a lot of traditional markets as well. And so there are kind of a lot of blue sky opportunities coming about in this market just because of kind of the Web3 and sort of open model that everything follows. So I think from that sense, whether you see leverage as kind of a good or bad thing is largely also a function of perspective, in the sense that I think there's a world in which users just take leverage punts and get liquidated and have a bad experience. But there's also a world in which users can get educated on how to use these tools. And of course, implementing product features like position limits and things like that can help lead to a better all-around experience. So that's something that we pay a lot of attention to. And I know everybody else in this space is as well. Just really, how can you offer a kind of an experience where users feel empowered, feel educated, and obviously not coddled, but I think the user experience and sort of the user funnel plays a big part in that. And so that's something that we try to pay a lot of attention to, so that that long tail of users who maybe isn't familiar with this market can get smarter and maybe start taking small amounts of risk and dipping their toes in the water. So I think in a lot of ways, it's also a means of financial education. And we're just seeing a much, much wider range of people get extremely knowledgeable about finance in a way that we haven't seen in prior generations, frankly. And so that gets me excited about the longer term possibilities of space and everything that's being built.
Yeah, and I think it's interesting when you kind of zoom out and realize like a lot of these tools, people are actively using it to improve their lives, or using it as an alternative, not even using the CeFi product. So kind of to quickly talk about, right now in the market, there's, as we speak, there's many ETFs that have launched in the past week, that are launching, I believe, today or yesterday, right? There's many coming out with high volume. Do you think that this is a sign that institutions want demand, or do you think this will pass on to some of the retail investors as well? Like, will we start to see these products drip down into people's 401k? And do you think that's how they'll get exposure? Or like, what are some of the cool use cases, just as broadly, I'll ask, that you all have seen people use derivatives for?
Yeah, I mean, I could speak on the ETF front briefly just to kick off there, but I think generally, I mean, I think we've been seeing institutional interest for a while now. I mean, we've had Grayscale's closed-end funds, which are a bit different from an ETF, but still kind of access on the market to a vehicle that holds Bitcoin or Ethereum. I forget what the actual number was on the first day that the first ETF had launched a couple of weeks back now. But a very large percentage of the orders that have gone through had actually been from retail participants in the market versus institutions. And I think a lot of the reason for that is ETF is kind of like a safety package for a lot of people. I mean, it's something a lot more familiar than going out and buying a Bitcoin on Coinbase or trading some Ethereum for an ERC20 token on a DEX, right? So, I mean, I think the ETF kind of ushers in retail to get their feet wet a little bit more. I mean, I don't think it's really kind of bringing users to the cryptoverse, if you will, in the same way that them kind of logging on to a Uniswap or dYdX and actually playing around is going to. But generally speaking, I mean, I think it's just good for the broad kind of adoption and visibility there. I mean, I think retail participants get a little bit more comfortable with the idea using these types of instruments. Maybe they buy some in their 401k or they hold it in a brokerage account. And now they're just a lot more open to kind of crypto in general after that. So, I mean, we kind of see it that way.
Got it, for sure. And in terms of like sort of the frameworks or the policies that are even needed to launch things like derivatives, I guess when we talk about completely decentralized derivatives, I guess can you guys sort of explain to what percentage of people out there or even institutions will use the completely decentralized derivatives, and to what extent will people use kind of a middle ground, kind of a breed, I guess, like not too risky, but just kind of like marginal risk, I guess.
Yeah. So I think it's really a matter of like sort of what I think the preferences of like any given player are with regards to kind of where they value compliance and in what jurisdictions. Like, I think the landscape is definitely evolving pretty rapidly. And from our perspective, like most of the major crypto native market makers are comfortable with the decentralized derivatives landscape. And we're also seeing some shifts in terms of a lot of the traditional market makers as well, working with non-US entities. So I think on the non-US side, there's a fair amount of kind of innovation and participation happening. I think with the US lens, things are still pretty restricted, and we go out of our way to also comply by those restrictions. But of course, like, again, it's not just the US. There's other jurisdictions that pose challenges as well. And so from our perspective, it's a little bit like you're building a jet in midair, and we think that this technology is inherently valuable and useful to end users, and that there's a way to kind of work with the regulatory environment to kind of bring about new frameworks for this sort of internet first or internet native era that we're in. Because I think if you look at a lot of the historical regulatory frameworks, they don't sort of account for the internet, frankly. A lot of them were developed decades before, and they definitely don't contemplate something like Web3, right? So our approach is very much to build as a company right now, but we have this period where we've set a clock for ourselves to fully decentralize in order to comply with what we understand the existing environment, the regulatory environment to be. And once we have a fully decentralized product, that'll be something that the the team plays a much smaller role and steps back from to a large degree. So we're sort of committed to that vision and what's involved to getting there. And we're very much working with the regulatory environment to make that happen to the extent we can. And I think a lot of the other market participants, like market makers, trading firms, hedge funds, seem committed to that ethos as well. And like I was saying, a lot of them are looking for ways to get involved now. So I think a lot of this is just collectively society sort of trying to come to a new equilibrium here, and it should feel uncomfortable, and there's a lot of stuff to work through. But we're optimistic for the future, definitely.
Yeah, as an aggregator, we're now looking into the decentralized derivative products and ecosystem growth on various public networks. And it's easy to see, like right now, decentralized derivative is getting more and more popular on various public networks, and most of them choose the AMM models. So for example, when you look into Binance Smart Chain, they just landed several decentralized derivative products on them, and they are having like large scale liquidity mining campaigns and incentivize users to trade on it. And so that's Avalanche. We talk with them, and they have the intention to bring in more decentralized derivatives on their platform, and NEO as well. As we talk to NEO team, and they also would like to bring in derivative products on them. So the chain is more like, to me, it's more like the DEX is building on various public network ecosystems. The derivative products are going to be more and more popular on various public networks. But again, the liquidity could be an issue for the AMM models, because you cannot support a good liquidity. And also speed is another issue, and efficiency is also another issue for on various public networks. But a layer 2 could be a good choice for everyone to build. So that's why you see, like on Arbitrum, projects are choosing Arbitrum and building on Arbitrum, and some are with order book models similar to dYdX, as we see some new projects coming out with order book models, and they choose layer 2 or various fork chains with high efficiency and to build on. So that's why we see, as an aggregator, there are a good opportunity, or like we can bring benefit to users on various public networks on those, and to aggregate those and decentralized and derivative products. Because like you have like lots of problems, or we can say like lots of trading opportunities on various decentralized derivatives. So that's why we can provide value there by aggregating them and finding the best price, and help users to trade efficiently on them to spot the arbitrage opportunities across various exchanges. So, so that's why we see we are quite positive on that aspect, because we see the policy there, but policy is like on one end they can lead the industry to a healthy growth and long-term growth. And on the other hand, like on other places, different aside from the states, decentralized derivatives can work out there without regulation or issues. So we will see how it goes on, and I'm quite positive with the trend with this development in the space. And I see like it is moving more and more into the direction of traditional finance, and the way people build derivatives on decentralized exchanges are working more and more close to traditional finance.
Yeah, and I think what you all are doing is very important in terms of kind of democratizing access to the market, or I should say kind of access to the data, so you can actually see the layout of different rates and options. And I think just with all the market activity we've seen kind of in the past 5 years, it's very clear that as new products launch, as users get more information, A lot of people are just learning about, how much interest they get at their current bank right now. And then I think, everyone here on this panel kind of either connecting with you guys or just using your actual products that your companies are building. I think they're discovering if they take it into their own hands, they can sort of make more money and use these tools. So one of my questions broadly is, what are some of the competitive advantages, I guess, that centralized finance still might have? Because, I think you guys are really democratizing access to a market that's currently controlled by a very small group of people. So in what ways do you think retailers or different types of traders will be involved? Like, do you think they will always be the source for liquidity? Or do you guys have any creative thoughts about how like a larger C5 company might be able to enter a DeFi pool or use one of your products?
Yeah, sure, I can take that. So yeah, it's an interesting question, and obviously like it's very much happening and sort of playing out in real time. What we've seen is that non-banks have tended to move faster than any of the banks. The banks are definitely looking at everything, seeing what's going on, and sort of determining their strategy. But I think in a lot of ways, because of where they sit, especially like the 23 primary dealers at the Fed, like they have a large book of existing obligations that kind of hamstrings them, and they just tend to go where like the market collectively goes. And so I think a lot of the kind of convergence possibilities with traditional finance will initially happen sort of outside of the banking side of things and more with like non-bank players like market makers, aggregators, non-bank brokers or kind of payment providers and that world, just because they're not subject to kind of the same existing obligations at kind of the highest levels. And we're definitely seeing movement on that right now. And so I think that gives us a lot of encouragement for DeFi really converging at kind of a more fundamental level with centralized finance long term, not just CeFi and crypto, but also traditional finance. But that being said, like still something that will probably take a bunch of time and happen in sort of very limited ways. We're definitely seeing a lot of connectors come out that want to act as middleware for very compliant players to access the DeFi ecosystem. And while at dYdX, we don't plan to build kind of a KYC version of our product the way some other DeFi players have, we do think there's potential for that middleware to kind of open up access to the ecosystem more broadly and help players with certain obligations kind of open doors they otherwise couldn't. So I think some of that's already happening, and definitely expect more to. But I think the banks could be the last to go. But even anecdotally, just based on conversations I've had with people at banks and talking to sort of enterprise players in the space, everybody's paying attention to what's going on in sort of the Web3 and DeFi side of things. It's more just on their personal time or personal side. And so I think that's also a telling signal for where things are headed. Curious to get other perspectives on that though.
Yeah, and I guess just to add to that, I mean, if I had to pick something that CeFi kind of had an advantage on today, it would probably just be, I think, the general onboarding experience. And by that, I mean, it's just a lot easier for people to, I should say it's a lot more familiar for people to open just traditional bank accounts or a traditional brokerage account and understand, okay, I hook my bank account up to this and I can deposit money and I'm good to go. I mean, I think using dYdX as an example, if I want to go trade perpetuals on the platform, I need to get some Ethereum and download a MetaMask wallet and bridge the Ethereum over to Starkware. And I'm all over the place at this point. And it's a lot of steps that I think we take for granted just being in this space every day. I mean, it's easy stuff for us, but you kind of give that to the general user and those simple steps, it becomes days of work for them. So I think kind of like Vijay's saying, I mean, you have players that are coming in as this kind of KYC middleware, but you're also starting to see kind of development of more of a abstraction layer, I suppose is one way of terming it. So things like, I mean, OpenOcean might be a good example in itself. Maybe you want to trade on dYdX and all you have to do is deposit some Ethereum to OpenOcean. There's no bridging or you don't need the MetaMask. like X, Y, and Z. You just cut out all these intermediate steps to make it a lot easier for the user to access these things. And I think we'll get to a point where maybe the user doesn't even know what they're accessing underneath. They have these abstraction layers or this middleware that basically lays everything out plain and simple for them, and dYdX under the hood, maybe Uniswap's under the hood, and you don't even know it. So I think that's probably like one thing that T5's got a little bit of an advantage of right now, but I think the gap is closing pretty quickly.
Yeah, and on that note, I think a lot of the products that we're talking about here, some of them I would say are individual, but I think many of them can kind of be thought of as like a pooled resource, right? You know, and like a quick anecdote, you know, the whole Wall Street bets movement to use kind of pooled capital, decentralized capital to really make an impact. So to what extent do you guys think that, you know, people will start to pool their capital and like, do you think the derivatives market will like kind of be fractionalized even more with like different rates? Like, will that, you know, to what extent will the rates continue kind of just descending, I guess, like lower interest rates, or do you think that's directly proportional to the current market conditions?
I mean, for us, I think it's pretty aligned with the current market conditions. I mean, I think that we expect a future where these things begin to compress pretty heavily. Maybe perp funding rates don't get hit as much, but maybe stable coin borrow rates come down quite a bit. Supplying or lending your assets, I should say, comes down quite a bit. But I think we're in the position, at least from CMS, looking out into the future here, I think we've got some time where we come down anywhere near what we're seeing today in traditional markets, obviously, but even coming down to standard 2 or 3%, maybe that's quite a bit off at this point.
Yeah, I would agree with that. Just given how much siloed capital pools there still are, there's still plenty of kind of even stablecoin to stablecoin ARB opportunities. And there's just like a lot more room to come down. So one other thing I think that's interesting is sort of from a market structure standpoint, like the number of venues. So if you look at traditional finance, at this point, you really have only one major venue in the United States, the Chicago Mercantile Exchange, and then there's the CBOE, of course. But you've had tons of consolidation in the broader derivatives landscape in traditional finance. But in DeFi right now, it's very much the opposite direction, right? You're having an explosion in the number of venues of all kinds, even derivative venues. And you continue to have a handful of dominant centralized exchanges. So I think for me, what's interesting is kind of seeing how that landscape evolves over the next few years. And I do think in crypto, there's greater potential for the market to bear a much larger number of venues, just given the variety of layer ones you have, the different ecosystems, the number of tokens that people are actively engaged in. And I think that's part of what makes the market interesting for a lot of people, is just the boundless kind of matrix of ARB opportunities that you have across all these pairs and the tokens and product types. Makes for a very interesting capital markets landscape. So in many ways, like the number of venues in DeFi, like may be part of its overall strength and resilience, but I could also see over a much longer arc of time, potentially some consolidation.
Yeah. When you look into the market size, centralized exchanges constitute like almost 90% still. So most of liquidity and most of users are still using centralized exchanges. So in most places, if you need to trade fiat, you still need to go through centralized exchanges to trade fiat. That's why like it is a must go way to trade on centralized exchanges. And when we look into the access, some of the tokens, they mainly exist in centralized exchanges. That's why we built a CDeFi aggregator to offer most tradable assets for users to trade. So, and some of the assets, they have larger they have better liquidity on centralized exchanges. Some have better liquidity on decentralized exchanges. So, as you see, like the tokens, also it's very interesting. Even like the CoinGecko top 100 tokens I see like some of them also have the major existence on centralized exchanges. They don't have that much liquidity on decentralized exchanges compared to centralized exchanges. So that's why, like, when you want to trade for large volumes, and sometimes on decentralized exchanges, the price won't be that good. So you still need to go to trade on centralized exchanges. And also there are some price differences across various centralized exchanges and decentralized exchanges. That's why there are some arbitrage opportunities there to trade across indexes and sexes. So we don't see, like, we are quite positive on DeFi, and we start from DeFi. So all we are looking for the solutions is to think from the DeFi traders perspective. And when they want to trade a token, they have more choices. On centralized exchanges can sometimes act as a complement to those DeFi traders if they want to trade on large volumes, and if they want to. Also, Joe mentioned about the cross-chain. So right now, if you want to do cross-chain, you want to have a gas fee on the other network. The most efficient way is to trade through centralized exchanges to get to buy the tokens. And we also think about that solution. So once we launch our cross-chain swap protocols to bring the cross-chain swap solutions to users, and the later stage is we will set our native token OE as gas fee to help users to trade with OE. You can just use OE as gas fee. If you want to do cross-chain swaps across the 10 public networks, we aggregate. You don't need to bother about the gas fee preference. So that's how we see. Only from the trader's view, there are advantages and disadvantages on various on DeFi or CeFi, and we are trying to connect them both to benefit the users.
Right, definitely. And, kind of going back to what we kind of talked about earlier, just kind of shifting the conversation to also just about trust, right? There's some industry leading companies in the industry, people know them, even some of the early aggregators, they trust them. But I guess talking about things like futures contracts and stuff like this, to what extent do you guys think that, people will trust, I guess, their existing bank and have that settlement still happen on the traditional market? Like even a Bitcoin futures contract is still settled in like centralized finance. But I think it's also interesting how some of the large companies are using, for example, Ethereum as a settlement layer. So where do you guys see, I guess, just derivatives in general, or like crypto derivatives? Do you think they'll start to actually be settled in crypto, or will we always have this imbalance where these large amounts of capital there? Is there going to be a way to actually provide enough insurance to get all this capital in?
Yeah, I'll take that first. So it's a good question, and yeah, I think again the landscape is evolving sort of as we speak, but we definitely are seeing a significant amount of at least stablecoin capital come in and into the smart contracts that the dYdX team has built, and so in that sense, we're definitely encouraged by the trust that existing users and the existing crypto ecosystem are willing to place in us. We only support USDC collateral at the moment, though. So effectively, that keeps things simple from a risk perspective. Of course, as we expand to supporting multiple forms of collateral, the logic and sort of risk embedded increases a bit. But that's definitely something we're taking our time to implement. And so in the meantime, we feel pretty comfortable with the USDC that's locked in our smart contracts. And I would say we really hang our hat on the track record of the dYdX team and the smart contracts it shipped and the flawless track record there. So that's just, I think, something that right now counts for trust among crypto natives. But I also think trust can compound over time, right? So as more crypto natives trust dYdX, OpenOcean, other platforms, that trust starts to count for something in the broader ecosystem among the long tail of users who say are still in their bank accounts right now. And so over time, they start seeing more getting locked up in these systems. There may be like incidences that are not planned, like erroneous liquidations or things like that. But if the system can, as a collective, kind of survive and be stronger coming out of those, I think those can also count for a track record. And we've definitely seen that with some DeFi protocols already in terms of, or even some L1s in terms of having a hiccup, but they came back from that and sort of regained user trust, right? And I think among the crypto native base, there's a great understanding of the fact that everybody is building a jet in midair. So I think crypto natives are forgiving of those mistakes at a system level. And that sort of allows a lot of the R&D and innovation to happen and get to a point where everybody can collectively take these products out to a much broader ecosystem of non-crypto natives and start seeing adoption with the help of abstraction tools like Joe was talking about earlier. That's kind of my take on it, but curious to hear others.
Yeah, I mean, I think I would generally agree there. Like, I think from my standpoint, I mean, generally speaking, trust is kind of like this perceived notion, right? And in a sense, it's like, how do you get there? I mean, with things like blockchain networks, you have the whole don't trust, verify. So I can go and check that something actually happened the way it said it did. And then I can go ahead and trust that things are working properly. I think kind of like Vijay is saying, it's going to permeate out from a lot of these kind of ground floor users that are comfortable right now. I mean, I think a big hurdle for just totally non-crypto native people is once they come to play with this stuff, it's kind of like you're by yourself. I mean, it's very much the Wild West. You're not calling up your bank teller, some support staff to help you. Maybe there's a developer channel in a Discord somewhere where you can find some help, but you're very much on your own. And I think that's a little scary for a lot of people. So I think as the kind of core crypto user base continues to grow and these things are kind of tested over time, it's really just a matter of signaling to the broader, I guess, population that this stuff, I mean, works how it says it does. And I mean, here's X, Y, and Z cases across the board of this going this way for these people. So I think it's just kind of this perceived notion that will eventually kind of be learned.
I'm trying to like telling some examples from our community, which is very interesting to us because we, at the beginning, we were quite conservative in aggregating the DEXs and listed tokens on OpenOcean. And some community members just came to approach us and push us for faster listing on lots of tokens that newly exist. So we are quite conservative about that, but they said, don't worry about this, we will take the responsibilities. We don't mind whether there are scams or not, we just want to trade on it. So that's why you see like the DeFi users, their risk appetite are quite high and their tolerance levels are quite high. So I think this is kind of interesting when you see people get used to that, and also it's like we have lots of tolerance for people to do RMDs, and even you are not perfect, people are willing to try to use the new projects, and to new projects are motivated to apply their new technologies in DeFi, which is very different from traditional finance. And this is also the thing that is keep this industry moving ahead, because the tolerance levels are high, and people incentivize and people appreciate innovative solutions, and they are willing to try out.
Yeah, people really appreciate, you're totally right. They really appreciate when there's innovation in things like pools or even, I believe OpenOcean Atlantic, you guys launched trying to make the aggregation more efficient, capital efficiency, and give people, you know, an easier way to swap these tokens. I think we were talking about that earlier. To kind of end things off, kind of just like two last questions. I want to each a chance to kind of talk about what are you guys most excited about in the next 6 months. But first, just a general question. To what extent does this idea of tokenized liquidity, right? Like right now, you get a loan from the bank. Not many people just, you have to put something up, right? But this idea of tokenized liquidity, the liquidity that you have right now, you could go to a pool and borrow against that. So do you guys believe that this is an important structure to DeFi? Or do you think, for example, uncollateralized loans and opportunities will start to see that?
Yeah, so I mean, I think we're definitely starting to see some more uncollateralized platforms at least start building. And a lot of this kind of revolves around building what people are calling like a DeFi credit score, if you will. So kind of evaluating their on-chain actions and determining how much to lend out to this user. There are a couple of platforms that are even doing things like integrations with Plaid, where they will go out, you type in your bank information, Plaid goes and kind of runs a diagnostics on your spending habit, and then they can issue an under collateralized loan or uncollateralized loan against that. So I mean, we're definitely seeing that come to the forefront. But I think generally speaking, I mean, like the essence of all of this stuff really is that it's supposed to be open for everybody. So I mean, I think the ability to go out and kind of lend or borrow or park your assets over here, maybe you mint a stable coin with them and a CDP. I mean, I think that's really like the underpinning of what's going on here. And the intent is kind of to keep this stuff as open as possible. And I think that's kind of the ethos of what's going on, at least right now in DeFi.
Yeah, it's like having that collateral is a way to really keep the system open and sort of sustainable. So would definitely agree with that. At the same time, I'm curious to see kind of how the uncollateralized innovations develop as well, just given that those could potentially unlock kind of further capital efficiency at a system level. But yeah, they're probably more designed for kind of more targeted use cases or kind of specific audiences versus a general purpose all access platform.
Yeah, we also like see collateral evolving so to uncollateral, and there are more and more cases there are more cases emerging, and this also increase the liquidity. And we are excited to see the involvements in the innovative solutions in DeFi spaces. But again, like trust is also an issue that we need to pay attention on. So that's why you see like credit scores and lots of projects they are launching this kind of credit scores or to borrow the credit system from traditional finance to DeFi and to help the development of uncollateral and to release more capital efficiency into the market.
Yep, I think you all gave great answers for sure. I think it's just like an interesting open discussion. A lot of people are getting excited that a lot of the bigger players are getting involved, but totally agree. This idea of openness, democratizing access to either information through markets or even all of the great tools that you guys are building are super important. I definitely think, yeah, it's going to take some time, but people are going to learn, based on all these great innovations in technology. They're eventually going to learn as they did starting with the wallet. I think to end things off, if each of you just kind of want to talk about what are you most excited about, either with derivatives or DeFi in the next 6 months, anything that you would like to see get built. But it was great chatting with everyone here today on the panel.
Yeah, thanks for the time today. So I'll just go first here. I mean, I think for us, given that we kind of play around on a lot of different chains, a lot of different platforms within each chain, I think we're getting pretty excited just about kind of how the bridges are going in this ecosystem. So we're starting to see a lot more kind of streamlined interaction between chains. And I think these things are in their very early stages still, but you have quite a few platforms where you can bridge assets from, say, Avalanche to Ethereum, But I think what we're excited about is to see a platform come to market that really streamlines these things. At this point, you've got protocols all over different layer twos, you've got them on different chains, and there really hasn't been something that just brings it all together in an easy way. I mean, it's still a process to kind of bridge this stuff. So for us, I mean, we are keeping our eyes peeled kind of on the interoperability front, and then just kind of development on bridges in general and how these can get a little bit more efficient in moving things around, whether it be between just different platforms or external chains.
Yeah, I can go next. So I definitely echo that a bit, just in terms of interoperability, whether that's solutions like Wormhole or even aggregators like OpenOcean, I think serve a big role in interoperability as well from the end user perspective. So definitely excited to see how that develops. I think for me, something I and the dYdX team are spending a lot of time thinking about is kind of enriching the end user experience in a Web3 context. And of course, for us, that's largely with the DeFi lens and kind of a derivatives trading lens. But how can we sort of create a better user experience? So whether that involves some degree of gamification or some kind of crossover with the NFT and the play to earn ecosystem, and really just seeing more convergence between financial infrastructure and what's going on kind of the NFT and the gaming side. Because a lot of these games and NFT ecosystems are becoming universes in their own right that kind of have things that have to be traded for each other and sometimes go down to a layer one. And so you have all these different aspects that I think sort of increasingly will cross over with sort of the financialization side of things and what's going on in DeFi. And so super excited for the innovation, kind of the weird, new, interesting things that pop up at that nexus. And that's something that we're paying a lot of attention to as well.
Yeah, and yeah, as an aggregator, we're excited to see the things getting more and more decentralized. That's why, like, the aggregator makes sense in a decentralized way. So when we look into the NFT markets, with NFT markets and metaverse, we are quite excited to see opportunities there. So we would like to keep eyes on the development and evolving of NFT, and we are thinking about how an aggregator can play a role in NFT. So that's one way we would like to see more interesting things happen in NFT and gamify. And also, like, we would like to see a real decentralized bridge and exist in the market that would be very beneficial to the users, because right now the bridges more or less are centralized. In a centralized way. So if there is any like real innovation solutions that can bring out the decentralized solutions, that's great. And the other things, like on Web3, we are looking into Polkadot and the Polkadot ecosystem as well. So we are landing on the aggregation of Polkadot ecosystem, and we are looking forward to see more and more mature products coming out and real applications coming out on Polkadot ecosystem.
Love all the different angles each of you gave. It was a pleasure having you here, Joe and Vijay, and thank you to Cindy for setting all this up with us, for supporting Reimagine. And I hope everyone watching this go back and watch it again. This was the OpenOcean kind of derivatives and innovative trading panel. And as usual, I'm your host, Roshan Mirajkar, and I'll let you all tune back into Reimagine 2021. Thank you.